Hello there, and welcome to this blog where we're going to be talking about financial performance indicators, or FPIs as they're sometimes called, or more commonly called ratios, different ways we can measure how well a business is performing from a financial perspective. My name's Gareth. You've got my email address there. You're more than welcome to drop me an email if there's anything you think I can help you with. I'm also very active on Twitter. You can follow me at AAT Top Tutor. I tweet links to various relevant resources. I answer questions. More than welcome to get in touch with me there. I'm a director with First Intuition. We're one of the UK's premier accountancy training colleges, providing training for AAT, CIMA, ACCA, chartered accountancy exams. We've been very fortunate in recent years. We've been very well recognised. We were awarded UK Accountancy College of the Year in 2010, 2012 and 2014. Even numbers, quite lucky for us there. We're the only college to ever win it 3 times in 5 years. I was really proud to be awarded UK Accountancy Lecturer of the Year in 2011, nominated by a variety of my students. And more recently, we were nominated for Study Resource of the Year in 2013. So hopefully, I can be of some use to you in this blog. Well, we're going to be investigating some of the key ratios or financial performance indicators that we can calculate in order to assess how well a business is performing. And the task that I've set here, actually fairly typical of what you might see in some of your level 4 assessments. This kind of information can be of use in budgeting and in fact in financial performance. What you can see here is we're laid out 2 different scenarios here, maybe based on different levels of activity in a business. You can see the scenarios have different volume levels. Scenario 2 is generating a higher sales volume, and that's leading to a variety of different financial results. You can see we've got a list of figures. These are figures that would be taken from perhaps budgeted profit and loss and balance sheet information. We've got a variety of bits of information here for things like revenue, gross profit, all the way down to receivables and inventory. And our job's going to be identifying which of these figures are appropriate for calculating certain ratios. We're asked specifically for some performance indicators here for each of the 2 scenarios, maybe giving a nice comparison. That might help us to identify which scenario we actually want to go for. So looking at a couple of ratios, and you can see that the task here is clearly identifying which ratios I need to calculate. So my job is really, firstly, to remember how each calculation works, and you do have to learn the different calculations for each ratio. The good thing I think here is the more you practice them, the easier that does become, so it will get better with practice. So first you've got to remember how to calculate each ratio, but then obviously I've got to choose the right figures to do those calculations. Well, let's start working down the various performance indicators that they're asking us for. And in fact, the first couple are looking at a couple of different measures of profitability in the business. We're actually asked to calculate a couple of different margins. Now, in terms of how the calculations work, I always think that margin, the word margin, is short for margin on sales. Margin on sales. So, however I'm going to calculate it, I'm going to put a figure on sales revenue. So in each case, we're going to divide something by sales revenue, literally putting a figure on top of sales revenue. With the gross profit margin, we take the gross profit figure and divide by the sales revenue. And because we tend to show margins as percentages, we're then going to multiply by 100 just to convert it into a percentage. So gross profit margin is gross profit on sales revenue times 100. Net profit margin is net profit on sales revenue times 100, again to put it into percentage terms. So just 2 different ways of measuring profitability depending on which of the profits you're interested in. Well, if we start with the gross profit margin, that's obviously using the gross profit figures, and that's going to be gross profit on sales revenue. So for instance, for scenario 1, we take the gross profit figure. So if you start the calculations with me, £220,500 gross profit, divide that by 500,000 revenue, and then remember to times 100 just to turn it into a percentage, and make sure you're careful with any rules for rounding in your assessments. We're specifically told here to give our answers to 2 decimal places. Now on my calculator, when I've done £220,500 gross profit, divide by 500,000 revenue and then multiply by 100, I get 44.1. Now 44.1, if I'm expressing that to 2 decimal places, just to be very, very clear, I'm going to put 44.10. Just to make it very clearly to 2 decimal places. That's a percentage figure. Basically means that for the revenue we're generating, 44.1% of that is turning into gross profit. Well, I can then do the same calculation under scenario 2. Now you can see scenario 2 is giving a higher gross profit figure at 255,000. So the profit is higher. But is the profitability higher? Because the profitability is comparing it to the revenue, and you can see the revenue under scenario 2 is actually higher as well. Now if I take 255,000 divide by the 630,000 revenue, and again multiply by 100, well actually I get a slightly lower margin. I get 40 point, and again making sure it's to 2 decimal places, I've got 40.4, I'm going to round up to 8. On my calculator I get 40.47619, but to round to the nearest second decimal place I've got to round the 7 up to 8. So you can see that scenario 2, although the profit is higher, the profitability is slightly lower. We're actually turning a lower percentage of revenue into gross profit there. Well, that's the gross profit margin. What about now the net profit margin? Well, it's a similar calculation, just using net profit rather than gross profit. Obviously, gross profit is only after deducting cost of sales. So gross profit is not actually the profit you're going to make. You'll have various other operating expenses to deduct from your true profit. So net profit is trying to maybe look closer at the real profit we're generating. Now, sometimes they might give you a net profit figure. In this case, they haven't done. So we need to be aware that net profit has sometimes got slightly different names. Well, net profit is sometimes called profit before interest and tax, sometimes called operating profit, and sometimes called profit from operations. It's basically the profit after you've deducted not just cost of sales, but all of the other operating expenses. So we'll be deducting admin expenses, marketing expenses as well. So we're actually now going to be using these profit from operations figures. So for scenario 1, again, it's the profit on the sales revenue. So 72,000 divided by the 500,000 revenue, using the same revenue figure that we did for the gross profit calculation. And remember to multiply by 100 to turn it into a percentage. And I get 14.4, and again I'll add a 0 just to be clear that that's 2 decimal places, so 14.4%. You can see the net profit margin obviously lower than the gross profit margin because you're using a profit figure that's after deducting more costs. And then when we turn to scenario 2, well, they've got a higher profit figure. The £98,700 is higher than under scenario 1, but that's then going to be divided by a higher revenue. So divide by 630,000 times 100. Well, actually, that does give a slightly higher net profit margin. I get 15.67. Again, I've got to round up that second decimal place in this case, so 15.67%. Now, in fact, if you compare the two margins we've worked out, if you remember under the gross profit margin, scenario 1 gave a higher margin. That perhaps implies that they're controlling their cost of sales better under scenario 1. But the net profit margin was a bit lower under scenario 1. So whilst they may be controlling their cost of sales better under scenario 1, perhaps other expenses like admin, selling and distribution are not being controlled quite as well. So I've worked out a couple of different profitability ratios. I've got my two margins. We've then got actually another profitability ratio. Now, the margins were comparing profit to revenue. we've now got return on net assets, which is comparing the profit to the investment that we would have on the balance sheet or the statement of financial position. There's a couple of different measures of the return on investment you could calculate. There's ROCE, or return on capital employed, ROCE, return on capital employed, which will be comparing your profit to the capital employed figure. And generally, to establish capital employed, we use TALCL, total assets less current liabilities. In this case, though, we're looking not at ROCE, but at RONA, or return on net assets. Now, net assets is just a slightly different way of looking at the value of the balance sheet than the capital employed. If capital employed is TALCL, which is total assets less just the current liabilities, well, net assets would be total assets less total liabilities, just literally the net asset balance from your balance sheet. Now you'll notice we are given a net assets figure in our information. If you had to calculate that for yourself, or if you have to extract it from a balance sheet, you would literally take your total asset figure, so both fixed or non-current assets and current assets, and then deduct total liabilities, so both current and long-term liabilities. And again, we're looking at a measure of profitability, a measure of return, so we are using a profit figure. And to work out RONA, we would tend to use again the net profit, or the profit from operations, or the profit before interest and tax, different ways of describing that figure. So for scenario 1, we need to take that net profit figure, and instead of dividing by the sales revenue, we're going to divide by the net assets figure, and then multiply by 100 to again turn it into a percentage. So we're going to use the £72,000 net profit for scenario 1, that profit from operations. This time they were divided by 1.25 million net assets figure, then multiply by 100, and that gives me 5.76% as the RONA, the return on net assets. For scenario 2, well, again, it's the net profit of £98,700 divided by the net asset figure, which is 1,570,000, just over 1.5 million. And if I work that out, I get a slightly higher RONA. For scenario 2, I get 6.29%. Again, making sure I round the right way on my second decimal place there. So you can see that scenario 2 is actually giving a better net profit margin and a better return on net assets. So perhaps from a profitability perspective, I'm thinking scenario 2 might be looking better. So far we've looked at 3 profitability ratios. We've then got a measure of revenue. Now we have got total revenue figures. You can see that scenario 2 is generating a higher level of expected revenue, but then again, it's expecting to sell a higher volume of units, so maybe you'd expect to have a higher revenue figure. In fact, if you think logically about why perhaps we've got that higher sales volume, how would you increase your volume of sales? Well, maybe you'd reduce your price. So we're now asked to work out the sales price per unit. Now, to work out the sales price per unit, all you actually need to do is take the total sales revenue expected and divide by the number of units. And in fact, we don't then need to multiply by 100 or anything. This isn't a percentage. This will be the pounds figure, the sales price I'm expecting to sell each unit for. So scenario 1, well, you can take the 500,000 expected revenue, divide by 10,000 units, and actually that gives me a nice round, well, it gives me a nice round 50 on my calculator, but again, we are specifically asked to do everything to 2 decimal places, so I'll just make it clear that that is bang on £50, there's no pennies required, so that's £50 exactly. When we look at scenario 2, well, yes, there's a higher revenue figure of 630,000, but there's a higher number of units as well. In fact, when you divide the revenue by 15,000 units, you should find a slightly lower selling price. That's perhaps why they're anticipating a higher volume of sales. So the sales price per unit slightly higher for scenario 2. That might be why the gross profit margin was going to end up being a little bit lower, because gross profit margin is really just comparing the revenue you're generating to the cost of sales for maybe producing those units. Okay, well, so far so good. Well, we've now got a couple of measures of what we call liquidity, looking at the kind of cash flow in the organisation. It's important we not just identify the current level of profitability, as we have been doing, but we're maybe trying to establish if that profitability is likely to continue. Is this business a going concern? Is it likely to carry on? You can imagine businesses with very poor cash flow, very poor liquidity. If they're not receiving money from their customers quickly enough, for instance, they might go bankrupt. And if you go bankrupt, it doesn't really matter how good your profits are, your business is finished, doesn't it? So we're going to look at a couple of different measures of liquidity here. Firstly, looking at the receivables collection period, or sometimes known as receivables days, or even debtors days, depending on the terminology that you use. Now, to work out receivables days, what we're going to do is compare the level of receivables, which for scenario 1, for instance, is £50,685, and we're going to compare that to the revenue being generated. Just effectively establish how long is it really taking those credit customers to pay us. Now, the way we'd work out the receivables collection period is you take your level of trade receivables, you divide by, now in theory, you would divide by just your credit sales. Imagine it's only credit sales that lead to a receivables balance. If people pay cash, they don't owe you anything. Now, in this case, we're going to assume that the full revenue figure is entirely credit sales. There's nothing told to us about proportions of cash sales or proportions of credit sales. So if that's the case in an assessment, just assume the revenue is entirely credit. And because we're asked for it in days here, I'm then going to multiply by 365, because there are 365 days in a year. And you can imagine the revenue figure we're given is for a year. If I was asked for the receivables collection period in weeks, for instance, very similar calculation. We take the trade receivables, divide by the credit sales. We just multiply by 52, because there are 52 weeks in a year. If we wanted it in months, we just multiply by 12. So actually, not a very complicated change to the calculation. Let's have a look at scenario 1. So the receivables, £50,685 that they're expecting to be outstanding from credit customers. That's the balance that would be on the sales ledger control account. Divide by the revenue for the year of £500,000, and then multiply by 365. And I get that coming to 37, and in fact to 2 decimal places is actually pretty much bang on 37 days. So customers are taking a little bit over a month to pay us under scenario 1. Under scenario 2, well, we take the £36,250, so you can see the receivables are expected to be lower, but the revenue is going to be higher, if you remember. So actually I'm expecting customers must be paying me significantly quicker under scenario 2. So if you take 36,250, divide by your 630,000, then multiply by your 365, because that's the number of days in a full year, that gives me 21, and again pretty much bang on 21 days. So you can see under scenario 2, we're expecting customers to be paying us within about 3 weeks. So significantly quicker than under scenario 1. That's an improvement in the liquidity of the business. That means we're getting the cash in faster, far less likely, you can imagine, that we're going to therefore run out and have cash flow difficulties. So receivables is one aspect of liquidity. You could also look at payables periods. Payables periods is looking at how long it's taking us to pay our supplier. You can imagine the quicker we pay our suppliers, the worse it is for our liquidity, because the quicker you pay your suppliers, the quicker the money's going out of your bank account. But here we're asked to look at the inventory holding period, another aspect of liquidity. How long do I have inventory or units of stock sitting in the storeroom? Imagine the longer you're holding on to inventory. If inventory is sitting in your storeroom for months and months, that's a lot of time that cash is tied up there. That can be quite bad for your overall cash flow. Now, the way we work out the inventory holding period is we take the level of inventory and we divide by cost of sales. Notice with the receivables period, you're looking at trade receivables compared to the sales level. Now, the reason for that is that your trade receivables is literally at invoiced value, isn't it? It's at the sales value, so we compare trade receivables to sales revenue. But with inventories, if you remember your basics of inventory valuation, we value inventory at the lower of cost and NRV, which will tend to be cost. So therefore we've got to compare the level of inventory to cost of sales. So don't make the mistake of using the revenue figure there. And again, because we want it in days, we're going to multiply it by 365. Now in this case, because I'm going to be using cost of sales, I actually need to work out what the cost of sales figure will be. It's not actually a figure we were given, but I would hope a level 4 AAT study would be able to derive cost of sales, because cost of sales is just the difference between revenue and gross profit. So for instance, under scenario 1, if you take your 500,000 revenue minus 220,500 gross profit, I reckon the cost of sales under scenario 1 must be 279,500. And to work out the inventories period, we're going to compare the inventories level to that figure. So if you take £32,150 of inventory, that's the value of the stock they think they're going to have, divide by the cost of sales figure for the full year, and then multiply by 365, and again remembering 2 decimal places, I get that coming to 41.98. So just being very careful that I'm as precise as they ask me to. So just under 42 days, that's how long we're typically keeping inventory for. And then similar job under scenario 2. So firstly I need to derive what cost of sales must be. So take your revenue, deduct your gross profit to work out the difference. I get 375,000 must be the cost of sales figure. And if I then compare that to the inventory level, so 28,750. In fact, if you look at how the numbers are working here, under scenario 2, we've got a lower level of inventory than under scenario 1, and yet the cost of sales is higher. That must imply that we're keeping the inventory for a far shorter period of time. So 28,750 divide by the 375,000, and again multiply by 365 because we're doing it in days. If I wanted it in weeks, I just multiply by 52, and I get an inventory holding period of 27.98. So actually less than a month. So you can see under scenario 2, we're expecting to be keeping, well, we're keeping inventory for a shorter period, and we're expecting customers to pay faster. Those are both good for liquidity. That's quite a positive indicator. So we've looked at a bit of profitability, we've looked at a bit of liquidity. Now liquidity is looking at short-term financing in the business, the short-term aspects of the balance sheet, really looking at current assets, current liabilities. We're then going to be looking at gearing. Now gearing is looking at the long-term financing of the business. Imagine businesses need to raise finance, and they'll tend to do that using one of 2 sources. They'll either use equity or shareholders' funds. This is money raised from their shareholders through perhaps issuing shares, or they might use debt. So debt would involve borrowing money, maybe taking out loans from a bank. 2 different sources of long-term finance, and it's quite useful to identify which is more predominant. Now there are a couple of different ways of working out gearing. You can either work it out as debt over equity, or you can work it out, which is how we're going to do it here, as debt over debt plus equity. They're just 2 different ways of showing the relationship between the 2 sources of long-term finance. You've got to be careful which one you're going to apply. So in this case, we're doing debt over debt plus equity. Now, the task has given us, again, you might be given a balance sheet that you have to pull figures from, in which case you're just looking for, firstly, the total equity balance, which would be the total of shareholders' funds, so share capital plus reserves, so do include things like retained earnings, revaluation reserves and the like. So we're told here what the total equity figures are under each scenario, and we're told what the total debt is, so how much borrowing are they anticipating having under each of the 2. Now let's be careful with the calculation here. So under scenario 1, if we start with the level of debt, so the debt is 650,000 they're expecting, divide by, well we then need to divide by the debt plus the equity. So divide by the combined total of 650,000 plus 1.25 million. And with gearing, again, a bit like with the margins, we'd normally express it in percentage terms. So I get that coming to 34.21%. Basically telling us that of the financing we've raised in the long term, 34.21% of it is coming from debt. What about scenario 2? Well, you can see a much higher level of debt, so anticipating they'll have to borrow a lot more under scenario 2. So 1,230,000 of debt divided by, and again we're doing it as divided by the total of the two sources combined, so divided by the 1,230 plus 1,570, and again expressing that as a percentage, I get that as 43.93%, shown to the two decimal places. So you can see scenario 2 does have a much higher level of gearing because they're going to be borrowing significantly more. That can be problematic, that can be dangerous for a business. You can imagine when you borrow you have to pay interest, so high levels of gearing can saddle you with very high interest obligations, and you can imagine if your revenue fell you might not be able to pay your interest, so high levels of gearing are often felt to be quite risky, quite dangerous. And then final performance indicator, we're going to consider the full production cost per unit. So how much is it costing us to actually make each unit? And when it says full production cost, I'm thinking that will include any material costs, labour costs, any variable production overheads and the like, all the sorts of things that would be shown within your cost of sales figure. So if we're looking for the production cost per unit, well, under scenario 1, we've got the cost of sales figure of 279,500. That's for 10,000 units. So divide by 10,000 units. So all we're doing here is a calculation, taking the cost of sales, which is effectively the total production cost, divide by the number of units or the volume of production, and showing it to two decimal places. Well, for scenario 1, I get that as £27.95 per unit. If we then look at scenario 2, well, you can see the cost of sales is higher, but then again, we are making more units, so it's perhaps unsurprising that the cost of sales is higher. What about on a per unit basis? Well, £375,000. If you divide that by 15,000 units, I actually get that coming to £25. Bang on £25. So I'll show the two zeros just so it's to two decimal places. You actually see that's a lower cost per unit than under scenario 1. Now, sometimes this happens when you produce a higher volume of units, you do get a lower cost per unit. It's what's sometimes called an economy of scale. You imagine as you get bigger, there are certain advantages. You know, you might be buying more from your suppliers, you might be getting some bulk discounts from your suppliers. Staff might be working more efficiently as they're producing more units. You can imagine if you do something at work, the more you do it, the quicker you get. There might be what's called a learning curve benefit. So there are certain economies of scale which might be leading to that reduced cost per unit. Well, I've actually now completed my analysis of the different ratios, the different financial performance indicators. So I've actually completed the task, but just thinking about the comparison of the two scenarios, which of the scenarios is looking best? Well, we sort of identified that with profitability, scenario 1 did have the better gross profit margin, but actually scenario 2 had the better net profit margin and the better return on net assets. So I might argue from a profitability perspective, it's looking like scenario 2 is possibly better. Now, fair enough, scenario 1 does have a higher sales price per unit, but then again, it was a lower volume of units, and you can see actually the higher volume of units for scenario 2 was leading them to a lower cost per unit. So, you know, maybe that's why the profitability is slightly higher for scenario 2. On the liquidity side, well, we identified that actually the receivables period and the inventory periods were both shorter. That's better for cash flow under scenario 2. Problem potentially is that scenario 2 had the much higher gearing level, didn't it? Gearing was lower, and generally the lower gearing is probably the safer. So you can see it's a little bit of a mixed bag as to which approach is better. I might suggest, though, that overall scenario 2 looks to me the preferable solution. It's got better profitability ratios, it's got better liquidity ratios, And although the gearing's a little bit higher, I don't think that's necessarily a major problem. There's not that big a difference between the two. Well, I hope you found that useful for helping identify some of the issues behind some of these ratios. As I said, the key really is to just practice, trying to learn the different calculations. I've tried to explain some of the logic underlying the calculations, but ultimately you've just got to learn them, and the best way to learn them is just to practice plenty of tasks until you get them right. But I do hope you found that useful. Thank you for your attention, and I'll maybe see you on my next blog. Thank you very much.